Welcome back to Investing Talk podcast. We are examining listener-submitted sources today to address a frequently asked question. Is brand engagement network a good time to buy now? Before we get into the details, remember to subscribe, like, and leave a comment below. If you have a specific company you want us to look into next, please let us know in the comments. All right, let's set the stage for this examination. We are looking into Brand Engagement Network, a really interesting microcap player in this conversational AI space.
Yeah, definitely interesting.
The reports we've received highlight not just significant momentum, but frankly, extreme volatility. This company is making some big moves, but it's sitting on a tiny financial base.
It really is.
So our mission today is pretty simple. We need to figure out the core operational drivers behind this recent huge surge and provide a crucial reality check on the underlying financial health.
Exactly.
Yep.
And when you look at a company like this, you're basically measuring two completely different things, aren't you?
Seems like it.
On one side, you've got the exciting, forward-looking, potential proprietary AI architecture, scaling partnerships. That's the story speculators are buying into.
Right, the narrative.
But then on the other side, you have the cold, hard realities of microcap risk. We're talking current financial losses, negative cash flow, and that high potential for market whipsaw.
So we're trying to bridge that gap for you today. Technical hype versus fundamental stability.
That's the goal.
Let's start with that narrative then. What exactly has been driving the enthusiasm and, that aggressive price action for Brand Engagement Network over the last, say, 3 months? It feels like the story really kicked off around summer 2025.
It was an extremely busy summer for them, yeah. It really suggests a rapid shift in their strategic focus and execution. The leadership team moved pretty quickly to strengthen the organization.
Oh, so?
Well, back in July 2025, they brought in Walid Chiari as both CFO and COO. Now, for a microcap, that kind of dual role, it signals a clear priority on immediate operational efficiency.
Makes sense.
But also maybe preparing for more complex financial activities, like, potential mergers or acquisitions down the line.
And they followed through almost immediately on that M&A signaling, didn't they? I remember seeing that.
They did. Yeah, that same month, July, they agreed to acquire Cataneo GmbH for $19.5 million, using a mix of cash and stock.
Wow. Okay.
So that tells us they're aggressively pursuing inorganic growth to scale up their capabilities fast, rather than just relying on, slower internal development.
$19.5 million. For a company this size committing that much to an acquisition, that's a really aggressive bet.
It is. It definitely sounds like a high-stakes kind of land grab strategy.
Okay, so M&A is one piece. What about their core technology platform?
Right. That was the next major move. Happened in August. They achieved general availability for their main platform, ISKY AI.
Okay.
And the sources emphasize two really crucial components here: proprietary architecture and enterprise-grade security. Now, in the crowded AI field, having proprietary tech is, it's the foundation of their potential future moat, right?
It differentiates them.
Exactly. That's what separates them from services maybe just built on top of OpenAI or some other large language model.
And that differentiation seems critical because it led almost immediately to what is arguably the biggest operational win we see in the sources.
Absolutely. Within weeks, literally weeks of that platform launch, they announced a massive partnership expansion with Swiss Life Global Solutions.
Massive is right.
And this wasn't some small pilot project either.
Right.
They are deploying their AI for customer engagement across 85 countries.
Hold on, 85 countries for a company we're calling a microcap. That sounds like a huge logistical challenge almost, disproportionate to their size. How do they even manage that kind of global footprint?
Well, that's where the analysis gets interesting, and it kind of connects back to that M&A activity we just talked about.
The Cataneo acquisition.
Exactly. Many investors believe that acquisition was strategically vital. It likely provided the necessary infrastructure, maybe the regional expertise, or even the development teams, to actually deliver on that 85-country promise without, collapsing under the pressure.
Okay, that makes more sense.
It really signifies they're aiming for true global scale, and they're leveraging these partnerships to essentially outsource their geographic expansion costs.
Right. That context makes the strategy much clearer. And then finally, just rounding out the wins from that period, they continued to strengthen governance in September, appointing Dr. Rui Carrasco to the board.
Yep, which is another signal, right? It suggests they're building a management structure capable of handling these large regulated international contracts like the one with Swiss Life. They're actively trying to position themselves to move beyond that early-stage microcap label.
Okay, so a lot of positive fundamental news flow over the summer. But the sources also highlight something unusual, an 11.9% single-day surge in September. And apparently it wasn't tied to any specific press release. What was driving that, if not news?
Yeah, that looks like pure technical dynamics and, well, what we often call retail-driven momentum.
Okay.
I mean, we talk about microcaps. We're talking about companies with a very small public float, right? Fewer shares available for trading.
Low liquidity.
Exactly. So when you combine low liquidity with a sudden spike in enthusiasm from smaller retail traders, any minor technical catalyst can cause a really outsized move. There just aren't enough sellers to absorb that sudden demand.
So it just demonstrates how volatile and sensitive this stock is to sentiment right now.
Absolutely. Very sensitive.
So given the speed of those summer wins, the logical next question is, okay, how does this translate into the calendar for the rest of the year? Let's unpack the forward-looking calendar. What events are set to test or maybe sustain this momentum over the next 3 months or so?
Well, the calendar is pretty packed with potential inflection points. The big one, of course, will be the Q3 earnings release. That's slated for sometime in October 2025.
That's the big test.
It really is. This is the first time investors get to see if those massive partnerships, especially Swiss Life, have actually started translating into reported revenue. The focus is going to be razor sharp on revenue growth and the adoption metrics for the ISKE AI platform.
Right. A successful earnings report would basically validate the execution risk they took over the summer. But even if the earnings are just okay, maybe middling, there are other sort of mechanical drivers that could impact the price, right?
Absolutely.
Right.
Yeah, later in October, you've got ETF quarterly rebalancing, and then institutional buy windows open up in early December.
The passive flows.
Right. If the company's getting more visibility and if liquidity improves, passive flows from tech and AI-focused ETFs could drive significant volume. And since institutional investors are currently, pretty underweight in this name, any influx could potentially generate a positive feedback loop for the share price.
Okay, now here's where it gets, well, really interesting. The market chatter, the rumors, the speculative upside that seems baked into the current valuation. These are just rumors, but they can move microcaps disproportionately.
Oh, they absolutely do. The M&A potential is persistent chatter. When you have proprietary AI tech targeted specifically at highly regulated industries like insurance and banking, well, it makes the company's assets extremely attractive.
To larger players.
Exactly. The rumors suggest that a larger enterprise AI firm isn't necessarily looking to buy the current revenue stream, but they might be buying the patent portfolio and the client list. Kind of a defensive acquisition, maybe, to ensure brand engagement network doesn't become a major competitive threat down the road.
So it's about buying the potential moat, not necessarily the current income stream.
Precisely. And furthermore, there's ongoing speculation about them securing a large-scale white-label deal. The rumor mill mentions a top 5 global automotive or insurance brand.
Wow, okay. If a partnership of that magnitude were announced.
Oh, it would be transformative overnight. It would just render the current microcap valuation obsolete pretty much instantly.
And we're also tracking some regulatory developments. The sources point to California AI data privacy bills.
Yes. The thinking is the company is potentially poised to benefit from support for those new bills. If stricter data privacy rules come into play, companies specializing in compliant enterprise-grade security, which is exactly what their proprietary architecture claims to offer well, they could gain a significant advantage in securing contracts in those regulated sectors.
Makes sense.
And finally, investors are also watching for any news on one of the company's 28 pending patents. Securing a key patent could really help cement their technological leadership claims.
Okay, this forward narrative is definitely powerful. It certainly seems to justify the excitement we've seen. But we cannot analyze this company based on potential alone.
Yeah.
We absolutely have to perform that fundamental reality check against all this technical hype and speculation.
Yes, this is where critical thinking is absolutely paramount for any investor considering this name. Let's start with the financials. Look, we have to acknowledge the extremely strong percentage growth. Revenue was up 183.41% year over year in 2024. That is, an explosive rate of growth on paper.
That sounds fantastic until you look at the actual absolute number.
Correct. The reported revenue for 2024 was only $99,790, just under $100,000.
Wow.
To put that figure in perspective for you, the listener, that is less than the average annual salary for a single mid-level software engineer in a major tech hub. It just illustrates how incredibly early and how small the revenue base still is, despite that massive growth percentage.
Right, and the cost of achieving that rapid global expansion we talked about, it's been substantial.
Substantial is putting it mildly. The company is critically not profitable. Losses widened significantly in 2024 to $33.17 million.
Oof.
Yeah, that represents a 187.4% increase in losses year over year. Now, look, this is a common strategy in early-stage, high-growth AI. You spend heavily to secure market share, develop the tech.
Sure, burn cash to grow.
Right, but the net loss is massive relative to their market cap. Their earnings per share, trailing 12 months, is sitting at negative $0.83.
And that widening loss, it creates a pretty significant risk profile, doesn't it?
Yeah.
Especially for a microcap.
Precisely. As a small microcap, market capitalization only around $20.85 million. High net losses and negative cash flow mean the company is highly reliant on periodic capital raises. They are burning cash rapidly.
No positive free cash flow reported?
No, none currently reported. So this poses a major liquidity risk. Failure to raise capital could stall operations, or more likely, it could lead to significant dilution for current shareholders when they inevitably issue new stock to finance that growth.
Okay, that's the cold, hard, fundamental reality. But let's switch gears completely, because the charts, the technicals, they tell a story of sheer, almost unstoppable force right now, driving that current enthusiasm.
Yeah, the technical picture is dramatically bullish. It almost defies the underlying financials we just discussed. The stock is up nearly 69% in just the past week, and over 62% for the month as of early October 2025. That kind of momentum is really powerful.
And the technical indicators are just universally screaming buy.
Pretty much. All the major moving averages, symbol and exponential, are signaling strong accumulation. The MACD, that's the moving average convergence divergence, is showing strong upward momentum, confirming this isn't just a quick blip, but seems to be a strong established trend.
Okay.
And the ADX, which measures the strength of a trend, is also bullish. It confirms a trending market is firmly in place right now.
Every strong trend usually has a caution flag somewhere, right? Where's the technical risk here?
Well, the risk really lies in the pace of the climb. The Relative Strength Index, the RSI, is highly elevated. It's hovering between 77 and 81.
That's high.
It is. This is the classic technical signal that while momentum is massive, the stock is approaching technically overbought territory. It could be due for a potential short-term cooling period, maybe some consolidation.
But if that momentum does persist, the sources seem to forecast a pretty wide bullish trading range, somewhere between $0 for 42 cents and $1.18 in the short term.
That's the projection, yeah, based on the current volume and momentum patterns. But what's really fascinating here is the sheer dissonance in sentiment.
How so?
You've got retail enthusiasm driven by these technical signals and the partnership news, just sky high, driving the price up. Yet, if you look at traditional Wall Street analyst sentiment, according to MarketBeat anyway, they currently reflect a clear sell consensus.
Huh. So the pros are saying, wait, while the technicals and retail are screaming, go.
Exactly. You have this major split between the professional market and the technical retail market sentiment.
Okay, so bringing this whole picture together, the aggressive growth strategy, the huge global deals, counterbalanced by massive losses, and then this technical frenzy. What does this all mean for you, the listener? Is Brand Engagement Network actually a buy right now?
Look, Brand Engagement Network is the absolute quintessential high-risk, high-reward AI speculation. It is definitely not for the faint of heart.
Okay.
The bullish argument, the upside rationale, it relies on basically three factors.
Yeah.
Their proprietary technology potentially solving complex enterprise problems, clear future catalysts, especially if they show success in Q3 earnings and execute on that Swiss Life deal, and of course the currently overwhelming technical momentum.
And if they pull it off?
If they can execute and really scale from here, the upside, given that tiny market cap, is potentially multi-bagger territory.
We cannot ignore those material risks that absolutely accompany that potential reward.
No, you can't. And they are material risks. The company is taking on massive execution risk, trying to scale globally while still operating with significant net losses and negative cash flow. Failure to successfully commercialize the ISKE platform, or failure to raise the necessary capital, will inevitably lead to substantial dilution. That could seriously erode the value for current shareholders. And let's not forget, its microcap size guarantees extreme daily volatility.
Okay, so how should someone think about the investment horizon then?
Well, we sort of see two separate potential strategies here. For the short term, maybe it's attractive for aggressive traders looking to capture that technical momentum. and the speculative upside tied directly to that Q3 earnings date, which is expected around November 13th, 2025.
Playing the catalyst.
Exactly. Playing the catalyst, but recognizing the risk. Now, for the long term, it remains purely speculative holding.
Okay.
It's really for investors seeking exposure to truly early-stage AI innovation, but only if they allocate capital they are completely comfortable losing. You have to recognize the high operational risk and the almost certain dilution risk inherent in this stage of development.
So it feels like we've witnessed a pretty textbook case here of speculative momentum currently outpacing fundamental stability. The whole investment story seems to hinge entirely on whether those recent operational wins, the new leadership, that incredible 85 countries Swiss Life partnership, whether they actually translate into meaningful, sustainable, large-scale revenue in the coming quarters.
It really does. And this raises, I think, an important question for you, the listener, to consider. Given those massive net losses and that tiny, tiny revenue base, how much more capital will this company realistically need to raise just to bridge the gap and reach self-sustainability?
Clear question.
And maybe more importantly, what might the impact of that future shareholder dilution mean for current investors if they have to finance, say, another $30 million loss next year? Something to definitely mull over.
Thank you for tuning in to Investing Talk podcast. Remember to like, subscribe, and comment below if you want us to look into a specific company next time. Until then, stay well informed.